Good morning, traders. Welcome to Fed Day. Morning, Still. Morning, Kate.
Good morning. How are the bills there? They increasing rapidly? Hello.
They don't stop going up.
Oh man,
crazy stuff. Crazy. Yeah, we'll get into the fun and games of the UK inflation in a bit and what that means for the Bank of England. Oh, here he is. K-Man just coming in.
Just in time.
Hope you got a letter from your mum while you're late, Kay.
Oh dear, oh dear, oh dear. Am I late? Jesus.
You know, yeah, well, we've already talked to all the headlines.
Important persons are always a little late, right?
You were late 35 whole seconds.
Oh my God.
Yeah. Not that we're counting, but
what's my punishment?
You get to cover the Bank of England tomorrow.
Oh no. Yeah, well, yeah, okay. There's no Bailey presser. I'll do the Bank of England.
Damn it. I should have made it the May one. Anyway, right, let's crack on. So, mate.
That puts you on the FOMC and Powell.
What, sorry?
Since I'm taking the Bank of England tomorrow, you cover FOMC and Powell tonight.
Oh, I didn't think that was going to change anyway. Yeah, I'm gonna put my feet up and let him waffle on. I think this time, everyone's got the video. Anyway, lots to talk about. Obviously, Powell, Bank of England, everything going on today. So we'll crack through the headlines. Japanese Cabinet Secretary Matsuno confirmed that they will be allocating more than 2 trillion yen from reserves for measures to cushion the blow to the economy from rising prices. So how they're going to do that, probably along the same lines of energy subsidies and the like going forward. So more fiscal measures from Japan that the BOJ have to worry about. The government also maintained its monthly economic assessment for March. There was a cut on the assessment of production. They see corporate profits, sees the economy picking up moderately, but sees some weakness. So they cut the assessment of production and corporate profits and sees the economy picking up moderately, but with some weakness. ECB's Enria said that higher interest rates require banks to sharpen focus on liquidity and seize the risk that banks might be caught off guard. If they get caught off guard 2 weeks after or a week or so after this is all kicked off, then they deserve to get a spank, in my opinion. No one should be getting caught off guard now that we know what the issues are. Bundesbank Nagel, the chief there, says that rate setters must be more stubborn in the inflation fight. He's going full tilt still on policy. He says our fight against inflation is not over. We should do more on cutting back APP repurchases, and at a later stage should consider slowing PEPP repurchases. So he wants to QT to increase there. ECB's Lane says inflation falling predicated on wage growth peaking this year. They keep telling us that there's not a wage spiral, but they want to see wages peaking anyway. ECB's Lagarde, I think she's on a hat trick of speaking this week. She's spoken every day so far. And she's come out with this gem. We are neither committed to raise rates further, nor are we finished with raising rates. So
they might raise, they might not raise, or they might cut, or any combination of the above.
Yeah. They may not raise, but they probably will raise, but they might not raise. And if they raise, they might not.
Yeah, and then the other gem was that they need a robust strategy. I was even surprised she could spell the word strategy.
Yeah, so
we are blessed with the central bankers we have now. We could say, as I said in the room, I say, where did we deserve Bailey, Lagarde, etc. We must have done something really wrong in the firm of former life, but it's actually a blessing in disguise, right? I mean, gives us something to talk about, laugh about.
That's a good point, actually.
Yeah, I mean, and actually now,
and sometimes gives us a trade.
Exactly, Ryan. Exactly. I was just going to say exactly the same. At least when we get their randomness and everything, it gives us trades.
Yeah, Mike says Lagarde is playing both sides. I don't think she knows what side she's on right now. So I don't know about playing both of them. You know, we know she's been hawkish, and I still think she's been given a bit of a slap by some for pre-committing to those 50 pip hikes, and she's had to dial back on that most definitely. But that comment, you know, neither committed or are we finished with hiking? It's just clarity for no one. Anyway, let's move away from the ECB onto the next bunch of clowns. And that is Sunak and Brexit, because now some of his Eurosceptic Conservative MPs say that the Stormont break in the Windsor framework, this Brexit deal on Northern Ireland, is practically useless. And Boris Johnson has come out saying he's likely to vote against the Brexit deal. Now, this Eurosceptic Conservative group is the ERG, which some of you may remember from the prior Brexit mess. So basically, Sunak, and the vote is today in Parliament, he faces a few more people against the deal. Whether it's enough to stop this vote passing is another matter. I don't think the numbers are there to stop it, but depends on what the opposition does as well, of course. But we've still not at the end of this road yet. One day. CPI in the UK. And if you look at any UK press, CPI unexpectedly, surprisingly, shockingly went up. And you may know, if you've been watching the Flow Show for a long while, it's not unsurprising to those of us sitting here. So CPI year on year was expected to drop to 9.9%, came in higher than that and higher than last month. The core number as well, also coming in higher than expected and higher than last month. So much for the BOE potentially going into pause, and some talking about rate cuts. Very strong numbers from the UK, though there was a little bit of relief depending on how you want to pick it. PPI came in a bit softer on the output measure, also came in a bit softer on the input measure. Now we look at input and output as in the prices firms have to pay for their goods or their manufacturing items, if you like. And then there's the output price, which is what firms charge to their customers for the stuff they've made. So it's a bit of a margin trade, if you like. They're both still going up, but they're both still easing. Input prices slightly higher than output prices. So that's a tiny bit of a margin squeeze for firms. Retail prices came in much higher on the core as well. Came in much higher on the headline as well. So this is a retail price index. As we know, grocery prices are running at record highs still. So long and short, no inflation let up for the UK. Something, as you know, I've been saying for ages, inflation is going to be far more stickier in the UK than anywhere else. And the central bank is far more useless at being able to contain inflation than anywhere else, mainly due to the nature of inflation. A lot of it is coming from abroad, imported energy, food and the like. So it's not inflation that the Bank of England really has a lot of control over with interest rates. They could hike to 10% interest rates. They could keep interest rates at 2%. It would have very little difference. The difference it does make is how the economy reacts to high rates, and that is how inflation is maybe addressed. That's what every other central bank is trying to do, but it's going to be a tough task for the Bank of England to do it. What that means is that a 25 pip hike has now turned into a 98.4% probability. Earlier this week, unchanged was a 55% probability, and a 25 pip hike was a 44% probability. So that's completely flipped around. What happens tomorrow at the Bank of England could be defining. We know they've been edging towards pausing or not going as high as the market expects. I think still they will be forced much higher. So it now stands as to whether we get a bit more of a hawkish Bank of England tomorrow based on these inflation numbers. What's going to be interesting also is the vote numbers, how they drop tomorrow, because that's one thing that can swing the initial moves in the pound as to how many people are voting for hikes or the decision, how many people are going to vote leaving rates unchanged. Maybe even some have been talking about cuts. The last vote was 7-2 for a hike, with 7 voting for a hike, 2 to keep rates unchanged. We're expecting a 6-3 split tomorrow, 6 voting for hikes, 3 for unchanged. So anything higher than that, i.e. 7-8 voting for hikes, would be looking a bit more hawkish on that front. Guys, what do you think of it? Still, inflation in the UK?
Yeah, I mean, inflation, we've talked about inflation in different parts of the world. So the UK is just like Eurozone, is a lot more dependent on energy externally, right? So as the price of energy stays high, inflation stays sticky. And yes, I know that oil has been dropping over the past couple of weeks, but this is a very recent move. You know, the past few months have been characterized by high prices of energy, and it takes energy to create everything. So inflation is sticky. We're seeing this in the UK. I find it very, very difficult to see how they cannot hike, even with the banking troubles. Now, I know I've said in the past that I think, you know, given the uncertainty in the banking sector, this might push central banks to be more cautious. But, you know, for the last few days, it seems that the central banks and lawmakers, they want to do everything they can, use every tool that they have, and they've already started doing that to contain the panic. And as you guys have said repeatedly and very correctly, it's a different thing between monetary policy and using tools to protect the banks. So theoretically, excuse me, with the inflation now ticking back up again in the UK, I find it very difficult to see any arguments for not hiking 25. And I mean, it's not like a hike is going to make a difference in the banking situation. It's more a move of confidence. But at the moment, given that things are seemingly contained, I think the market pricing 98% chance or whatever that is of a 25 hike is fair. I mean, I don't know what you guys think, but I see very little reason for at least a majority. I see a very little reason for a majority to vote for a no change. Maybe we'll get one or two dissenters again. You know, you're always going to get the doves who are going to find an excuse to be dovish. But overall, I think the Bank of England will hike because inflation is still out of hand.
Yeah. What do you think, Kay? Does this maybe have them taking a bit more of a hawkish slant tomorrow, or?
I guess they have to on inflation, and somewhere they are also supported by the latest data. And I keep repeating myself in many countries, not really falling out of bed yet. Actually, if you look at it on the face of things, the latest round of numbers was worse in the US than they were in Europe or the UK, for instance. If you take them as a whole, right? You have the occasional outliner there, but so no, I think they have reasons to be hawkish. Now, we know Bailey and his lot, and those doves also in there. It's gonna take a very hawkish man, I think, to keep the Bank of England in an extreme, or not extreme, but in a real hawkish scenario. But they can't do otherwise, right? Yeah, I think 25 is. I've always thought that they should hike anyway, but I think it's the data also are supportive for it. We haven't seen real bad data. Okay, we have like those lending numbers and stuff, the credit numbers were not great, but it's about the same everywhere. So no, I think they have every reason to be hawkish tomorrow on the Bank of England. And regarding, as Stelios just said, and we have been saying here repeatedly, that it's a different thing between monetary policy, the sheer move of interest rates, and then what they do on the sides. We have seen, for instance, in the States, the Fed has injected a massive amount of liquidity, and then the rest is over to the Treasury, right?
Yeah.
So in that for the FOMC tonight is keeping me also on the hiking side of things. They probably will do 25. There's not really a reason, because the numbers have been coming off a little bit, barring the last big domino, which is the employment report. They've been coming off a little bit, so that will keep them really away from the 50 already. That is a good enough reason. But on the other side, I mean, there's only as much as they can do for the banking sector as well. And let's face it, we are not in a 2008 situation, as we have already said so many times. Whether it is in the States, whether it is over here with the Credit Suisse. Credit Suisse was potentially a much bigger piece than the American regional banks, in my opinion, because they are or were a systemic important bank. But yeah, I mean, going back to the FOMC, I don't see them near hands still. There's no reason, you know, and inflation is still way higher than they think. The jobs are keeping up, and the rest of the numbers have been volatile, although, as I said, a bit weakening. So that will keep them for sure away from the 50 BPs this time as well.
Yeah. Well, just looking at some of that other data from yesterday as well. Canada CPI came in. It's following the same direction, coming in lower. Core coming down, headline coming down, much sharper than expected. So for the Bank of Canada, that keeps them firmly on pause. No reasons there for them to change policy. It's just going to be, I think, a question of whether the data starts to diverge between different countries. You know, we've already seen inflation up in some Eurozone countries, you know, Spain, France, Germany as well. And now we're seeing it in the UK, US. We had that little bit of a hot PCE report, the core PCE number, but inflation still coming down, although the core's coming up. It's all becoming a little bit messy in the inflation world. So that's to be expected going forward as well. But it is a bit of a divergence, particularly in the US. We got the Philly Fed non-manufacturing index. That's basically services. That came in at minus 12.8 versus 3.2 prior. This one, I don't know why it's not put on any calendars. So I'll have to read out the numbers. New orders was a negative, minus 15.4 versus plus 6.2 prior. Employment 3.2 versus 15.9 prior. The wages and benefits cost index 25.1 versus 44.2 prior. So we know manufacturing had been a little bit lagging or a little bit sloppy the last few months from the PMIs. We know the Empire and Philly Fed manufacturing were poor numbers. Now this is a services number that's turned around the other way, and you may remember we got strong services numbers in the PMIs and ISMs last month. So the question is, was that a little bit of a New Year pickup and it's falling out of bed this time or not? We won't find out until Friday when we get the first round of flash PMI numbers. Maybe that will shed some light. So particularly for the US, be careful with that, depending on what the Fed do. If the Fed are a bit hawkish and the market fancy some dollars, Friday we get a poor PMI number, that's going to flip those rate expectations once again. And good for trading, good volatility, but you've got to be prepared to go both ways on this. And just to highlight the data divergence yet again, housing, existing home sales are strong up. That broke a 12-month, I think 12 month streak of falling numbers, and we saw from starts and permits earlier this week were strong as well. So the housing market doing okay. So as I say, there's a lot of divergence coming into the data, particularly for the US, and we need to see if that happens in other sides, because it becomes a game of what data matters more than others. For the UK, services matter more than manufacturing. For the US, it's a bit more 50-50, likewise to other countries. So for the Fed coming up, I still think they go to 25. I still think they say they're going to stick to their path of getting inflation under control. Whether they ease up on the language that we heard from Powell not a week or so ago at his testimonies, that rates might have to go higher than expected. Also, we've had those hawkish Fed members, quite a few of them, saying that the dots are, or they're going to be moving their dots higher, so a higher rate ceiling. That's going to be the judgment tonight. The hike size is one thing, where the expected path of rates are going is the next. If they're not as high as what Powell and the others have led us to believe because of these worries in the US, that's going to be taken negatively. Overall, for the dollar, obviously we keep an eye on yields. They're going to tell us what we need to do. Whatever happens, I can't see, and I've been saying it for the last few weeks, I can't see the Fed or expectations getting back up to some of these highs we've seen in things like yields and the dollar. I just can't see it happening. There's too much going on, too much uncertainty coming into the data. So I think that any rally we get in the dollar today will evaporate fairly quickly. And the market is going to be sticking with a bone that the Fed, they may take rates up, but they're not going to be able to keep them up there for long, and then they're going to be coming down quickly. Stel, what are your thoughts on the Fed?
Well, I was saying last week that with this whole situation with the banking uncertainty, Credit Suisse, I was saying that I think there's increasing chance of the Fed playing defense and basically not hiking. I think that with the way things have gone this week, and with the measures that have been taken, and basically with the way they have protected the confidence in the system, I think now it's all clear for them to go 25. And I think they probably will today, and that's what the market's pricing, pretty much, I think 80% chance, 85% chance. If they don't go 25, that means that there's serious problems which we don't know of. The big question is, what will they say? Because I think 25 is a given. It could be that Powell just comes out, they hike 25 and he says, look, inflation is still high. We need to keep hiking. Maybe at the same pace. They did 25 last time, right? They're going to do 25 this time. They can keep going at 25s until inflation comes lower, which it is coming lower, but until inflation comes to their target or close to. So he could say, look, we're doing 25. The market is very well supported by, swap lines, guarantees, deposits, all that. We're going to keep going ahead with our plan, which is to control inflation. So there is a probability that it's a possibility that this will happen. If that happens, I think then risk gets sold because that means that they're not close to stopping cuts still this year. So I think this is the main risk now, that they hike 25 and that they are hawkish, at least not dovish. Let's put it that way. So what do I think they're going to do? I think Powell, given the whole uncertainty and given the fact that I don't personally know how big the extent of the damage in the banking industry is, I think he's probably going to do 25 and be relatively neutral on the meeting. And you know what? There's no point in taking a risk being either too dovish or too hawkish, right? There's still too many uncertainties out there. So I think 25 neutral, and it could be a bit of a non-event, unfortunately.
Oh,
after all that's happened this week, it could become a non-event, really.
I don't know. I think it's going to be a fairly choppy one, whatever they do, because there's, like you say, there's still a lot in the market who are uncertain. I mean, Ali's made the point. Why are Goldman Sachs saying no hike this week when others are saying 25 pips? Well, we've still got Nomura saying that they're going to cut rates by 25 pips. So you know, that tells you something about bank forecasts. They change like the weather, and you know, they're also there for a bit of clickbaitery. But yeah, this is one of those. It's like the ECB. You know, I said the ECB were going to go to 50, and they went to 50 because they've got to continue with their fight for inflation, and they've got to separate that from financial stability, because, as I've repeated, they built these tools up over the last 10, 15 years to cope with these problems. There's no point having to use monetary policy to cope with these problems, because that's admitting that your tools that you've just built over the last 15 years aren't up to the task. So they've got to keep that separate. But as Stell says, there is a risk that if there's stuff that they know about that we don't, that there's bigger problems, then if they do that through monetary policy, that's going to create big waves in the market, because the market will, to put it bluntly, shit the bed. That's a technical trading term we use on the trading desks of old. But, so Kay, you're in the same boat, I think. You know, do they keep the policies separate and talk about the financial risks separately to what they've got to do on inflation?
Yeah, completely. They as I said, they're supported by the employment report, right? And the inflation. The rest can be a bit brushed under the carpet as volatile data. So yeah, base case is 25. I don't think they can even envisage to do 50, but that would be like a bit of a shocker. But I think this, and Powell, as we know, is used now to walk a very fine line, which he, regardless how policy is perceived, the way that he walks fine lines is pretty spectacular. I must say, me having been 40 years in the market and seen a lot of central bankers, he's one of those who is very, very able to walk the high wire lines, you know. The one thing that he may say, he will have to comment at one stage, and that's going to be for the presser, what they did with those liquidity injections, because it reduced the effect of QT that they have done so far by half. And there may be a bit of a kicker in there of how the market perceives, because that is talking about the liquidity in the market, right? And if you add liquidity in the market, that's going to be perceived positively by asset markets. If you take away liquidity, then it's going to be perceived negatively. And I think it may have a bigger impact than just doing the 25 or so. The rate hike will send one message, and I think the liquidity stuff will be, and that's where I joined the Stell comments. It's about the same also as saying we don't know whether some dead bodies still have to fall out of the cupboard, or we know that it's not that that severe, and then we pick up the QT again. And I think there will be, for me at least, a big message in what he may say. All else equal, of course.
Yeah. So do you think the Hawks have perhaps had a bit of a wake up call? You know, I'm talking the Arch Hawks, like the Kashkaris and the Bullards. Do you think they may not be looking as high for the rate ceiling now?
We'll hear about that afterwards, because they were the thing is that the whole saga, the whole story happened when they just entered their quiet period, right? Yeah. And so we don't really know we don't really know what they are thinking right now. I think that may be where your dot plots come into play, right? They may express their feelings, and then afterwards we will hear traditionally about all of them. But there they may express what they think through the dots. Yeah.
Yeah. Okay. So let's go, mate.
Yeah, I mean, I know we're already on the FOMC, but I would just perhaps, when I take the screen or so, give a couple of comments about what happened. The thing in Japan you talked about, the stimulus package, and then the Xi Putin meeting.
Yeah. I'm going to just jump onto that. Got some last lines to do, then we'll get really stuck into the prices. So staying in the US, and Treasury Sec Yellen said there will be time to evaluate whether bank regulatory adjustments will be needed to address root causes of the current crisis. The Fed's going to be in the firing line for that because they had supervision of SVB, as we mentioned this week, and questions are being asked there on why they didn't take a stronger arm. They flagged some of these problems, including the interest rate risk, but the bank apparently did nothing. So there's going to be questions over why they didn't push harder to keep that contained. On the Russia-China stuff, there's been a whole mix of stuff going on. China and Russia have agreed to further energy cooperation. Putin said he's going to boost LNG supplies to China and oil as well. Also, they're going to extend pledged oil cuts through June. That's to everyone else. Various areas reported that Putin and Xi paid great attention to the Ukraine peace plan in the one-on-one meeting, but not a lot came out of that in terms of what may happen from that. While they were talking about peace, Russian defense minister said fewer and fewer steps are left towards a nuclear collision, and Russia will respond to possible depleted uranium ammo supplies to Ukraine by Britain. In a joint statement between Russia and China, they said that Russia-China relations do not constitute a military political alliance. So overall, not really a lot came from it. Nothing that signals any steps towards any solution in Ukraine or China pushing Russia to get to the negotiating table. It was all a bit of backslapping how great relations are and how they're going to do much more business together. What do you guys make of what came out of that in the end?
Well, I think it was worrying. Unless we get a quick, a fast call from Xi to Ukraine, what he said he may be doing, if I recall correctly. Yeah. Unless we get that, and there's real talks coming out of there. I don't. It was extremely underwhelming on the peace side, in my opinion. I didn't see personally anything that is going to stop Putin from continuing. They will never tell us officially or openly if China is going to support Russia with weapons and stuff, but behind the scenes, I think it's a worry. I didn't hear anything really positive coming out of that meeting.
Yeah, Stel, you got any thoughts on all that stuff?
Yeah, it worries me a little bit. I have to agree with Kay. It's they were both talking about how the majority of the transactions between the two countries are now being done in yuan and rubles, and the collaboration is strong and this and that. So basically, they have a common enemy, which is the US. And I don't like it when the world kind of reduces itself to two sides. Especially if there's lots of power on both of them. It used to be US versus Russia. Now, Russia, China is a very, very powerful combination. So it scares me a little bit. I don't know, market wise, what are the implications? Well, none yet, but, things like that brewing can't be good.
Yeah, I think the market's got a case of fingers in its ears over this.
Yeah, what about these equities, man? Seriously. They're amazing, resilient. I'm clapping. I'm like, yeah, well done. It's fantastic. But how? Why? Anyway, I don't know. I don't know is the answer.
Yeah, we've been a bit confused about some of these moves. We thought maybe Kay was saying that perhaps some of the bid in the euro is expectation for the Z Putin meeting and maybe some resolution. That hasn't really happened, and yet euro's still holding up. So is it just undoing of some trades that we've had this week, risk trades into the FOMC? Are we going to just shuffle the deck after, get back to dollar being strong? Who knows? This is a tough part of trading. You've just got to as we've been saying all week. You got to stay nimble. You got to go with the flow, go with the punches. Don't get married to a side or a bias at the moment, because all it takes one headline and everything turns around. So for me, coming into this one, I do have a bit of an idea for cable, purely based on what's happened with the CPI report. I was hoping maybe that we might get a move up to 124 over that CPI and just everything going on. Not looking the case at the moment. My thought was that this might be a good one to short into over the FOMC, because if the Fed do come out and hike 25 and stick to their plan, you're going to see the dollar bid up a bit. That will cause a dip in cable. If you get a decent move in that, you know, a couple hundred pips, then that may be something to look at, flip into a long post FOMC to run into the Bank of England if they come out with something that's a bit more hawkish. Plus, I still think that the dollar, any dollar strength we see is going to go pretty quickly, evaporate pretty quickly. So that's going to be another tailwind for something like cable. But you can cast your net across a lot of dollar pairs at the moment. You know, euro dollar still knocking up against or just below that 108 level. It's found a bit of a brick wall in the 80s yesterday. It's struggling to really get close to 108. Maybe the market's pushed itself enough over the last day or so. It doesn't want to go out on a limb now. I wouldn't rule out a move above 108 before the FOMC, just if the pressure bears fruit and we get a little bit of a stop blow through. But I'll be careful that it quickly reverses and we sort of revert to mean and hover around this 108 area. I'm still long in this one. I'm just got my finger hovering over the trading button now because I want to take a bit more off into 108 if I see it, bring my stop up a bit more and lock in what I've got. What are you guys thinking trading wise for this one? Dollar yen's creeping up again, but I can't help but think this is still a rally sell, Kay, do you think?
Euro crosses, mate. I think a lot has to do with the euro crosses. Yesterday we have seen that 100 points rally in the euro sterling. Okay, today it's been undone for half on that CPI, but then euro yen beat, euro Canada beat, euro Aussie still beat on dips. I think it's a lot of it is euro, and then in addition is again the Japanese stimulus package, right? They will continue, and I think that's one of the factors, to me at least personally, is why yen can strengthen on stress elsewhere, on expectations for UEDA, whatever. But then if you look at behind the scenes what's going on, I think yen it's tough to buy yen for more than a few sessions at the time. That's me at least, because of those stimulus packages. UEDA already said, and Kishida, that they will work closely together. Yeah, that's my view on the yen is long term still unchanged. Long term I'd rather be short yen than long the Japanese currency.
Kay, did you say it's difficult to buy yen for more than a few sessions or seconds?
Yeah. Buy.
Okay. Sessions or seconds? Seconds, more like.
Yeah, sorry, my English sucks.
I know the feeling. It is times like that. I mean, you had a trade in that mix that was almost like seconds. So yeah, that proves the point. You don't want to stay in stuff for too long. And he wants to look at gold. I'm not trading it personally at the moment, but it has weakened off. I still think a lot of this move was the bank panic and, you know, players like hedge funds moving into something that's a bit safer than everything else. You know, you've got two bottom lines of safety, if you like. If you're not going into treasuries, you're going into gold, and that's the next step from just going into cash and sitting on your mattress full of cash. So I think that was a big move up there, and I'm not surprised to see it come off, because now, you know, the bank situation is seemingly easing. So that's why gold has come off, but it hasn't come off, you know, as much as it's gone up in the last few days. So yeah, keep an eye on that one. Maybe something to do with what happens in the dollar. Gold's always a mover on the dollar. But like Stel says, you know, stocks are holding up relatively well. You know, just looking at the S&P back in the 4,000s, you know, it's trading nicely between the big figures. You know, a lot of people had eyes on that 38 handle. Off it went. So now what we're going to be looking at, getting up towards that 41 area, perhaps. That's where we had resistance before, with an old area, and then up towards the 42 that everyone was looking at before. So, you know, you've got these decent ranges, and these are the sorts of levels you want to look at over these events. Okay, you can mess around in the middle here, trading in and out between 4,000, 3,900, whatever you want to do. But keep an eye on the wider picture. Know where your bigger levels are, because they're the ones that are really going to stand out. You know, we can flip flop around here. People can make plenty of money doing that. But if you want to get in these big, strong moves, look for the big levels, and you don't have to put a lot of risk into them. If we get up to you know, 40.70s, 40.80s, you can have a trade. If it breaks through 41, well, you know, you're probably heading higher. So, you know, 20, 30 pips risk is all you need on that. Same up here. You can trade the 42 with maybe 20 pips of risk. And, you know, if it stays in range, well, then you can sit in a nice short, maybe all the way down to the lows again. So the same exercise I do for these big events with its data, central banks, whatever, is I go over the charts, I look at my levels. I might have 4 or 5 levels, and then I whittle them down. I say, right, well, I've got these 4 or 5 levels, but these are the ones I really want to concentrate on. You know, being picky about cable, it's 124 or 120. Yeah, we may not get there, but those are the levels. If we get there, they're the ones I'm really going to be interested in trading. And I do that with all the pairs. So, you know, have a look. Dollar CAD, 138, and these highs is a consideration. 135s is a consideration on the downside. And if the Fed is volatile enough, you may get some of those levels. So always have them at the back of your mind, the ones you want to look at. Kay, time to do your tour.
Jawohl. What am I going to do first? All right, let's do. I'm not doing this very often. I'm going to have a look at the euro dollar, because I think there's a bit of an interesting zone here. We've been in this kind of setup and doing higher highs. I think the interesting zone is right here. It's just above 108 that everybody's looking at, and then we have the 38.2 showing up here again around 108 and a quarter. That's my zone here, my initial zone on the top side, 108.1025. And on the downside, okay, we have a little bit already at 107 and a quarter, I'd say, and then the bigger one is going to be around 106.80. I have similar view. I think the euro for the time being is attracting some decent flows if you look at the crosses. If anything, if we see like an initial blip on the dollar higher, that would take the euro back into low 107s, high 106s. I'm going to be tempted to counter trade this just because of the current strength of the euro. We've seen that the European banks have very little exposure to what's happening in Switzerland. So I'm tempted to think, as I've already said, that that Swiss story is, even though it could have been a big one, seems to be for the time being contained to Switzerland. But we cannot judge about any final implications before we know, of course. But in current context, I think any move back down to 107 or below is going to find buyers on the euro dollar. Yeah, your cable, you've already done it. I can live with that range that you put up there. 120, 124 looks pretty good to me. It's been rejected many times above, so 4.5, and then on the downside. But I don't think it's far away right now. I'd say we already get bids even somewhere between 122 and 120, 160 in the current environment, I'd say. So yeah, so overall, I mean, it's selective. I'd rather buy euros and sterling than something else, for instance, because those are the two who, in my opinion, hold pretty well. The dollar yen is a different animal, very, very different animal to me. Let's go on to the daily, and there's only, to me, one level to watch today on the close, and that's here, 132.70. Whether you're above or below, I think that's going to be decisive for the next sessions. If we are below, then we have to look at what's going on again somewhere in those low 131s, because then there's a risk for this dollar yen rally to completely reverse. But if we're above, then I wouldn't be surprised if we start to move back up to high 133s, and why not back up to closer where the prior top was, just ahead of 135. That's just for the dollar yen. I am rather watching those yen crosses, and there's two that really caught my eye today, and that's this euro yen again. It's back above this 142.70, 143, the figure zone. It's really very big, and I think that has to do with what we talked about those Japanese stimulus packages as well. There is some risk though popping up again. I just saw that GAF posted an article saying that Russia is moving some of its war material back to the Kuril Islands, which is a disputed island group with Japan. So we have to keep an eye on that as well. But in any case, this one looks very big to me. Any move lower to low 142s, mid 141s, unless there are big accidents again on the risk front, I think he's going to find buyers again. That's my bias anyway. And another one that I'm looking at is the sterling yen. You can see we back above the wedge. Tried it last night, and we started to move up again there. We are in an interesting zone here, though. 163.20 up to 163.80, and you find it also back here, and here is going to be a zone worth monitoring, and that is something to watch. And I like to watch those crosses when it's very uncertain on the dollar. Those might be different things to do, and then depending on what happens before the FOMC, like for instance, right now those yen crosses are bought, and the euro crosses are bought, and the sterling crosses are bought. Those are interesting things to watch, depending on what happens with risk pairs. And I always like to keep a close eye on what's happening in the crosses. And then emerging markets. This one, dollar MEX, it's really rejected very strongly above 19, and I've commented briefly on it in the room this morning, where we are now. I think it's a bit unclear here, but there's still a big zone here in the low 1840s on the dollar MEX. I think MEX could do well on a neutral to mildly positive FOMC today. The MEX could continue to do well. Where the MEX could have trouble today is the two extremes. Either a very hawkish that would send the dollar higher, or a panically dovish one, which would signal that the Fed is worried about the banking system. And that will not be good for emerging markets, regardless how we take any dollar move. So the extremes are going to be a little worse for the MEX than what a middle path to mildly positive path would be. Then I think dollar MEX could really put this 1840 under pressure, and perhaps start to take its way lower again in stuff like Euro MEX. But Euro MEX, I'm a little hesitant right now, because I've got this pretty bullish feeling on the Euro process. Kill my squawk. Another one that I'm watching, and that after this meeting with Xi and Putin, as I said, I was really disappointed by the meeting, even though people can say like, oh, what could we have expected? Well, I mean, China wants to be seen as a little bit of the peacemaker right now, and but they really failed there, I think. So the dollar China is one that I'm going to keep an eye on. I think there is very little reason to buy Chinese yuan right now. Also, don't forget we have the on the 27th, I think it is, we have the RRR cut kicking in. So if there's anything positive on the dollar China, I think we can have a test, move back through this triangle and go for a test of 692.5, 693. If in turn we get a very bearish dollar scenario, then we can't rule out a retest of the 684.85 again. But what I did this morning, because of my disappointment on those meetings, was buy a little bit of Euro China. I haven't charted it. I just did it because of a feeling. So I bought a few euros and I bought a few dollar China. So I'm rather long Euro China for the time being, expressing this relatively negative bias that I have on the CNH. We got to take a look at energy as well. So let's first go back onto the daily. So as people know, I've been commenting on this. To me, this 62, 67 zone is historically been a bit of a heavy traffic zone and what I would call equilibrium zone, because we've seen how it collapsed through in 2020, and then when it was positive, when the central banks were injecting money, where the economies were crawling back out. Look, we also traded a lot in this 62, 67 area on WTI. So to me, this is a bit of an equilibrium zone. It would be really looking panicky if we start to break below, and especially below this additional trend line that I have in the 61s. And then if you look at it on the shorter term frame, the wedge or whatever we came out of here, the possible target is also in that 61 zone. Not saying that it has to reach this target. I really, for the time being, don't really know what's going to happen to oil. But if it goes down there, I think I'm going to be starting to put on my butcher's glove and catch knives. On the top side, I think we have to look out for what's happening between 70 and 70 here in the short term. More medium term, I think if we get a move back up to this 73.5, 74 area, that's going to be quite a big zone. That for oil. Gold has been asked. I know Ryan already took a peek at it, but to me, we're on a bit of a crossroad here, and we're hanging just around there. I think 1960, 19 and a quarter. That's going to be the range to observe in gold. If we see a dovish enough dollar meeting tonight, this could easily break back through 1960. If in turn Powell succeeds to put a bid under the dollar, this 19 and a quarter has to be monitored, in my opinion. Silver, less clear. We're hovering around. We could argue that this is a bit of a bullish flag, right? For those watching those things. So yeah, and that would the underside would coincide with the support coming in here around the low 22s, and the top side anything back through 22, call it 55, 60 or so, and then need a confirmation above 22. That's where it needs to get through to gain traction again, to be able to go up somewhere into the 23 bucks. Have I covered anything else? Does anyone want to look at anything else while we're on it? While I'm on it.
Still, we got any?
I think you've done a splendid job as always.
Yeah. Then I give it back to you.
No problem.
Oh, yeah, not gas. Oh yeah, you're a nookie. You're right, Catherine. You're a nookie. Tomorrow we'll have the Norges Bank, right? Just before we even do the show. Look, this has been in a very powerful up channel, right? Since December. But it's also been responsive to what's happening in Brent right now. So with all trading higher, we have found a top. So I think you have to really be careful what's happening around closer to 1150. And yesterday, this is the initial little support where we bounced off yesterday. So keep an eye on 1130. But I think more importantly is going to be this one here, and that's 1120. And then we are talking about 1115. So 1115.20. That's where we should find support with a level of last resort for this run around 1110. So you have like 1% here, where it should be important tomorrow to monitor what's happening in the Euro NOK coming out of the Norges Bank. Let me have a quick peek. Are they scheduled to? Yeah, they're scheduled to raise 25 BPs, right? Yeah, it's also possible because with the weakening of the Norwegian kroner, it gives an easier reason to hike, right, for the Norges Bank. So I guess they will remain on the path that they have signaled as well last time. Dollar Norway still looking bit because of the weakness of the Norway. But keep an eye out if tomorrow we start to get back through 1121 and then call it low. Oh no, that's still the Euro Norway. Sorry, on the Dollar Norway. No, the Dollar Norway is a bit of a different one. On the Dollar Norway, we also had this upward channel, but looks a bit weaker because of the dollar coming off, right? So this one is one that you need to pay attention to tonight. I would say around 1060, 65 probably, and then you're looking at a bit higher here. And actually on the daily, we might be making, if we get back up to 1073 or so, 75, you might be in a bit of a head and shoulder here. That remains to be seen. And on the downside for tomorrow, I think your bigger zone is going to be around 1030s down to 1020s. Then about the Norwegian kroner, Kathy, I hope that helped you. And with that, back to you, Mr. Ryan.
Thank you very much, Mr. K. Yeah, my overriding thought, as said, for the Fed tonight is any dollar strength probably not going to last very long. That's what I'm going to be focusing on tonight, seeing if that happens. What I want to share quickly is that if you're looking for somewhere to be, can you see my screen okay?
Yes, sir.
Good. If you're looking for somewhere to be and, come and join a community where we're going to be going over everything that happens tonight, come and join us in the ForexAnalytix platform there. If you use code FFL20, which I'll put in there as well, you get 20% off for as long as you hold a subscription for that. And also don't forget to check out our traders funding program, where you can leverage up your account for minimum risk, i.e. just the assessment fee. Let's get the right link, shall we? I've blown it. So you can check that out as well. As I say, for the price of the assessment, you can have an account up to $1 million, and your risk is only the assessment fee. So you don't not put in your own money to risk there, you put in our money to risk, and you'll receive 75% of everything you make. So not a bad deal there all round. Very good for traders in America because you can get around the FIFO rules by using this account, i.e. you can do a slice and dice strategy we like to employ. So check that out there. Link is in the chat function there. And on that note, I do wish you all many pips. R8, yes, it is MT4 and MT5. So you have a choice. Any questions you have at all, you can see on the screen there, there's a little button All you have to do is click that and you can have a chat with the wonderful people in the back end there. Any questions you have, you can put it there, or speak to us as well. We're happy to take your questions on that. So yeah, I wish you all the best of luck tonight with the FOMC. If in doubt, stay out, pick up the pieces after, make loads of pips. I want to hear some good stories tomorrow. Thank you as always to Kay and Stel for their valued input. And we shall see you all tomorrow for the aftermath, the after party.
Thank you, Kay. Thank you, Ryan.
Cheers, guys.
And see you at the chat room.
Yeah, see you guys.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.